People coming through. Great. Andrew from Hornchurch. I can see you there. And we have got... Good. It's all trickling in now. All the numbers. Great. Fantastic. Everyone can hear me. That is great. So let me start off with sharing the first screen with you. He says optimistically, and there we go. Let's share the screen. Turn, share, screen share on. Look, I've been doing webinars and talks and writing articles and books about trading since 1997. So this is just a continuation after what's that, 25 years, quarter of a century. Yes, and the lack of hair or the white hair is evidence of that. Quarter of a century of this. And this is just one element of that. I want people to have the same passion, energy, and excitement I have about trading. I will share with you my insights from, well, my Diary of an Internet Trader published by the Financial Times, and also everything that I've learned both as a trader, as a hedge fund manager, and as an author of international best-selling books published by the Financial Times, who are my publishers, big, fat, thick ones. So I'm going to give you all of that in this. Some of you are repeat viewers. Hi, Tarek. Hi, Yogesh. Yogesh, you messaged me earlier today on WhatsApp, and I replied back with my calendar. So we'll talk. So this one's about trading as opposed to investing. Okay, so welcome on board, everyone. Now, let's go. First things first, this is not specific investment advice. It's not individual advice because I don't know you individually. It is, as with all my webinars, it's educational. It's to teach you a set of skills, and it's informational, give you my views on where the markets are at the moment. Top tips, as I always tell you, checklist. As David Kite, who's in the rich list. The rich list came out last Sunday. He's in the rich list. David Kite, trader, floor trader on Live, said one of the people that I interviewed for my book, Mind of a Trader, when I wanted to learn about trading when I was at university, were here to make money. And it shocked me because I was at the time 27 and I'd never heard a British person say, we're here to make money, because it was just seen as, oh, it's just not the done thing. Anyway, we're here to make money. Therefore, let's pay attention. Let's not be embarrassed about the fact. Close your doors, make sure you've got pen and paper, and please focus. So why are people highly motivated? Maz, hello. No worries. You've sent me lots of messages, but I don't mind at all. I'll catch up with them today as well. We've got Vladislav from Perth. We've got Hornchurch represented as well. Got a whole bunch of people coming in. We've got about 100 of you in at the moment. Normally, after about the first 5 minutes, we get to about 200. Robert, Sven, Graham, Peter, Anil, Tim, Jonathan, Nilesh, Neil, Tarek. Welcome one and all. This is one reason why you're highly motivated. Now, this is a good and bad thing. Hedge funds have turned bearish on stocks. So a lot of people are saying, listen, Alpesh, I'm motivated to trade because I want to make some money because I'm worried that my investments might be flat. Well, actually, on the investing side, if we stop pick, we should still not be flat, but that's a separate issue. Investing is separate. This is about trading, and this is motivating people to trade. People are worried about inflation, cost of living crisis, and so they're looking at side gigs. They're fed up with their jobs, whatever else it might be. This is why we're motivated more. Well, I've seen more motivation than ever with trading. Well, since in the last 20 years, I think I've seen more people getting, I mean, you see companies like Robinhood out there. You see companies like Webull out there. There's just so much of it going on. And I think trading activity has increased as well. People had furlough checks to play around with as well, which is a bit worrying that they were trading those. So where are we? Well, there's also this concern. That's the S&P 500 over the last decade. And there's this concern. By the way, that red line is a trailing 25% stop. And it rarely drops 25% from its peak, or if it does within the next month, it's back over it again. So if you wait a month, you'll know. If it's below it for more than 2 months, then, you got serious trouble. And people are concerned that, hang on, whilst it's not dropped 25%, if it continues going lower, maybe we want to trade it. And of course, with trading, all you're doing is either buying low, selling high, just like cans of beans or anything else you might buy and sell, or you're selling high and then buying it back low. Same thing, buy low, sell high, or sell high, buy low. Selling first is called shorting. Buying first is called going long. So there's people who say, well, if the markets are going to fall, there's going to be more opportunities to make profits from falls. How do we do it? And let's at least learn about it or investigate it. At least investigate it. Hi, Edward. Been a while. Edward. Oh, so that must be Edward Ramsbottom. Remember that. And I think you've got the son in Hong Kong, if I'm not mistaken. Vikram, hello as well. Welcome one and all. And it's similar with the NASDAQ. Now that, again, the red line is a 25% trailing stop loss. So it's 25% from the highest it's been. And that's going back 10 years. And I think the only time it's actually crossed below it intra-month was during COVID and then bounced back up again. And guess what? We're at it again. And that's the first time in a decade. Okay, so people are saying, well, wait a minute, how do I make profits from this if we're likely to continue falling? And the MACD, which I'll come to later, that MACD momentum shows that it's falling off a cliff. I mean, visually, just look at that. It looks like it's falling off a cliff. It doesn't look like it's about to turn around and do a U-turn anytime soon. And if that's going to continue falling, surely there's money to be made from that. Okay, so given that that's the case, what are the specifics? Well, people have seen some of these drops. Now, either they're thinking, well, can we short these? Can we trade these? Or they're thinking, bloody hell, oh, it's a bloodbath out there. Feel free to take a picture of that if you wish. I'm not going to specifically go into that. What I'm actually going to look at later, I picked a set of instruments that we're observing right now, as in right now, live, because as you know, the markets are open 24 hours a day, 6 days a week, pretty much. So I'm going to go through some of these later. I mean, there's a lot of instruments I could have picked, everything from coffee to Coca-Cola to Baidu and Boeing and 3M and all the rest of it. But I've just picked these for the purposes of this webinar. And I'll tell you what our positions are in these in a moment. They're not, this one's short. The FTSE, we just shorted it. Well, you can see it there. I mean, you can take that as live during the webinar because that just happened about, I think, about an hour ago. So we're short the FTSE at the moment, and I'll come back to all of these. So I'll explain what these things are. There's a lot of things to trade. I don't care what I sell. I'm like a supermarket. I don't care what I buy and sell, as long as I can make money. Morrison's doesn't care what it buys and sells, as long as it can make money. So how do we, given these broader concerns of the market, where is the money to be made? Let's keep to the focus. Well, first of all, these are the traders whose insights I'm going to use. I've said this to you before. These are the people I interviewed for my book, Mind of a Trader, in '97. They were the world's leading traders. Bernard Opperty, hedge fund manager, now a hedge fund manager. Bill Lipshutz, formerly global head of Forex, is now a hedge fund manager. Pat Arbor was then the chairman of the Chicago Board of Trade. John Najani, you'll see him on CNBC all the time. David Carr. These are just some of them, because they taught me everything. And then I set up the hedge fund. It took 10 years. I thought it would take a lot less time from meeting them. You know, you think you meet your mentor, you think you meet a billionaire or a multimillionaire, you sit with them and you say, look, I'm interviewing you for a book, FT publish it. You think within a year, I'll have all the secrets. Boom. Actually, it's a lot harder than that, setting up a fund, because you've got to raise capital. And just because they tell you the strategies that they adopt does not mean a lot of people say, oh, okay, you met them, great, here's a shed load of money we'll give you. No, you've got to build up a track record. And that's what I'm sharing with you now. Okay, some of the other names as well, that I will share with you as we go on throughout this. So these were some of the people. I'll share the others. I always tell people, remember, follow me on LinkedIn and you'll get more information. So what are my reasons for trading and why you all want to do it? You probably all want to do it for the funds. Okay, let me tell you the other things. Fun, freedom, and philanthropy. Hopefully philanthropy led. Obviously you look after your family first, and after that, it's the easiest hard money you'll make, so make sure you do something fulfilling with it by doing something useful in life with it, which is philanthropy, okay? Now, that's my reasons. For everyone else, it's going to start off with funds. Bottom of the pyramid, we just want to make money, all right? And given that we've only got two decisions to make, when to buy, when to sell, okay, and given that at the moment, the sell decision looks pretty easy for most things, okay, that's all it is. Do we buy or do we sell? If we think it's going to fall, we'd sell and then buy back later. If we think it's going to rise, we'd buy. Given that there's only two things we have to do, whether it's spread betting, CFD, share dealing, options, doesn't matter what it is. Doesn't matter whether it's Forex. We're going to look at Forex in a second. We'll look at Bitcoin. We're going to look at Apple. We're going to look at Citi. We're going to look at FTSE, the Dow, Google. We're going to look at all of it. So given there's only still two decisions to make, when to buy, when to sell, how come, as you can see from what I've drawn at the bottom part of that, how come 66% of investors lose money with various brokers? And I've taken three. I think it was CMC, IG, and City Index. I forget which, but pretty much they all have similar. 61% lose money, 66% lose money. You'd think it'd be 50% lose money, wouldn't you? I mean, you know, if you had to take a guess. And then you think about it some more, you go, oh, okay, now I can see 2 decisions to make. How come so many lose money? There's a plus side to that. You'll notice with some brokers, only 60% lose money, only 60. Now you might think, what do you mean only 60? Well, that means 40% are making money. My job with all my credentials and my experience and what I've been trying to do for the last 25 years, and it's bloody fulfilling because you're basically giving people another career in some cases, but in most cases, 90% of cases, a side income. All right, only 10% want to do it full time. Even less than 10%, probably about 8% want to do it full time. The vast majority just want to do it on the side. There might be surgeons, there might be doctors, dentists, lawyers. They're not going to leave all that to be traders. Unlike me, I was a barrister. Most will say, no, I'll just have it on the side, just like property investments. You know, they'll have it on the side, rental properties. They don't go and say, that's all I'm ever going to do. I'm going to give up my career as an accountant or whatever. Okay, so my job is to get you into that 40% of profitable traders. Now, 40% is a big goal for me to aim at. In fact, my job is to make sure that I increase the chances of you being one of the 40% who are profitable. Now, I might say, hang on, Alpesh, I thought 90% lost money. You know, that's what I heard somewhere. 90% used to lose money trading until 2 things happened. First, they realized, actually, don't use Cypriot brokers, don't use non-FCA regulated UK brokers, because all the others will make sure you lose 90% of the time because they're going to rip you off. Secondly, once the FCA said you've got to put how many of your clients are losing money, guess what the brokers started doing? They had to compete with each other for your business, because this headline has to go on the front page of every UK broker. So the broker looks around and thinks, shit, if we're 66% losing and the next guy's 61%, people are going to go to the other guy. So let's bring down the numbers. So they brought it down from an embarrassing, initially when the FCA required this, it was like, most of them were 90% of our clients lose money. And it's like, how embarrassing is that as an advert on your homepage of a broker? 90% lose money. Oh, right, thanks, I'm off. Then it became 80. A few months later, then it became 70. Now it's gone down to about 66. What I'm hoping is eventually the brokers will have to be so efficient that it'll just be 50% of our clients lose money. Because they know if they do that, they'll just corner the market. Somebody switches the plug tomorrow, but it's a bit like Virgin and British Airways. They're not allowed to collude. It's a criminal offense. But they're looking at each other's prices and see what each other are doing. But if one of them goes down to 50, and somebody's going to bring a brokerage out, which will do that. Okay, so I'm just saying. So I'm saying it's been a better time, and gradually it gets better. Statistically gets better, and that's why we want to learn it. So what are we trying to do in all of this? And as I say, I'm going to return to the FTSE trade and why we're short right now. Why we might be long by tomorrow morning, who knows? But I'll explain that in a second. Maz, thank you. And I'll reply to that in a second. This is it. Buy low, sell high. That's all it is. I've shown this image before. It doesn't matter what the product is. It happens to be euros. It could be the FTSE. It could have been Amazon. It could have been BP or Shell. All we're trying to do is buy there and sell there. So you, me, and George Soros see the same data, but 60% of people lose money. They can't even get that right. What the hell? What are they doing wrong? It's probably the simplest game in the world. It's like tossing a coin, and yet 60% are losing money at tossing a coin. They've only got to make 2 decisions, when to buy, when to sell. We pretty much all get the same price data. I mean, there won't be much of a difference between the euro price I'm given and Soros is given. There'll be a tiny point, but it won't be enough to explain why I'm losing money 60% of the time and he's not. So we want to get down to what I want to do is show you and I'm going to give you the flow chart in this webinar as well of the decision-making process. There's a new flow chart I created yesterday, so the ink's still wet on it. I'm really proud of it as well. I'm going to put another poll up. This is a slightly more difficult poll, this one. Okay, just so you know, sterling has been dropping recently and it's at multi-year lows against the US dollar. Okay, so put another poll up, have a look. Right, so what are the essential elements? Now, and part of this is my job, and part of my job is to make sure I give you other information, such as this. Take a picture of this as you wish. Now, this is from a broker. It's actually from FXCM. It's their data. It doesn't matter who it's from. The data across brokerages is likely to be the same. When I was writing, it wasn't this book. It was one of my other books. When I was writing it, we got a shed load of data. I mean, you know, we got a lot of data from brokers and found it and all the rest of it. And what you'll see is virtually on every single currency pair, the average client loses twice as much money as they make, pretty much on average. However, with certain currency pairs, they seem to have an advantage. And we're not just going to talk currency, we're going to talk DAX, Dow, FTSE. So don't worry. We're going to talk stocks, we're going to talk crypto. But I'm just saying, this is the data on this. So I'll share this kind of stuff, take a picture of it. I'm not going to go into, but there are certain currency pairs, Australian dollar, Japanese yen. And one of the things I say to my students is, look, I really want you to focus on minor versus minor currencies or major versus minor. Major is sterling, yen, euro, or US dollar. Everything else is minor. So focus on either minor versus minor or major versus minor, such as Australian dollar, Japanese yen. Because as you can see there, statistics shows you've got a greater likelihood of making a profit. Okay? And that's if you're average. My job is to make you above average by the end of this webinar. Obviously, you know, the advantage you've got over average people is they're not on this webinar. You are, or, you know, they haven't got all the sum total of all my knowledge and all my books that are going to be put into this webinar for you. And by the way, I'm going to give you a free download link to my book as well on this. All right. So on this webinar. So we've got that. We're going to use some other edges that we can get our hands on. And we've also got to decide on a few things, which is which instruments, how do we look at them? How do we know when something's going to rise? And that looks too complicated, Alpesh. I don't want a life where I'm looking at that. Well, good, because we've got to make it that it's suitable to a life we want to lead and it doesn't take up too much time and so on. When you're trading, if you want to be a billionaire trader, and I'm not there, if you want to be a multimillionaire trader, you want to be just a, you know, pays a few extra bills kind of trader, that's what your trades are going to look like. And just so you know, let's get realistic. You are not going to have only big wins. Sorry, but you're not. My job is not to give you some kind of crystal ball or some kind of magic thing which says, oh, you're going to be right 9 times out of 10 or 10 times out of 10. Sorry, doesn't exist. All right. My job is to show you how not to have any big losses, because then what's left? Well, you'll have some small losses. Why, Alpesh? Why can't we be right all the time? Because the time machine hasn't been invented yet. All right. You'll have some small losses. You'll have some small wins. Well, why did you enter those trades, Alpesh? Well, at the time, they looked like high probability setups, but this is what happens. And 20% of your trades will be big wins. 80% of your profits will probably come from 20% of your trades, the big wins. They're the ones where the trend just keeps on rising. I wish all your trades were big wins. My life would be easier, but then I would have cornered the market in money, wouldn't I? Okay? Of course it doesn't exist. If it did, life would be easy. Every single successful hedge fund has a profile like this. If it doesn't, it's either in denial or it's committing fraud. It's as simple as that. How did they know Madoff was committing fraud? Because his figures didn't look like this. He just had a load of big wins, or even just all small wins. He didn't have any small losses and didn't have any big losses. Is fine. You know, professionals shouldn't have big losses. How do we do it? Well, let me tell you some lies that you've been told. And this is how we're going to create a process now. We're going to create a process in trading which is going to simplify your trading, and it's going to make sure you don't do some stupid things which causes people to make losses. All right. And this is it. One lie is you make a few big bets. When I interviewed the world's leading traders, I thought they were going to say to me, Alpesh, you know how to get rich? You just go all in now. You wait and wait until you're absolutely sure and you go all in. They didn't say that. They didn't go that. Okay? Well, they didn't say you go all in. They said, oh, we don't put too much money in. Actually, I'll show you in a slide in a second what they did say. Wasn't big bets. And the other lie is, oh, you got to watch the markets with lots of pretty screens. If you really want a lot of screens, you know, in your cave or whatever, man cave or woman cave or whatever, buy them. They're £100 from Amazon, but you don't need a load of screens and go nuts. What we've got to focus on is return on time invested. That's what we're going to do. What we're going to focus on, given that we've got this much choice, this is how much choice we've got. You and I will never trade the same two things. I can give you a strategy on trend following, momentum. You and I will, it's unlikely we're going to pick the same time to trade in the same instruments over the same period. It's just unlikely statistically, especially if I'm looking at 10 to 20 different instruments to you. The chances we do the same trade at the same, it's just, you know, the permutations are almost infinite. So we're going to make sure with all this choice, we focus on certain key instruments. I'll tell you which ones I like in a second. By the way, I should say, well, actually, no, I might do that now. I do like a mixture of foreign exchange. Why? Because it's uncorrelated to equities, pretty much. Okay. It means that I could have, and I like trading in equities, which is in the opposite direction to my long-term investment. So if my long-term investment, say in an Amazon or an Apple or a PayPal, or the markets as a whole, so the Dow or the S&P, I'm keen to trade short whenever I can on the opposite instrument. So take this with the Dow, which we're short at the moment since this morning. Okay. Why? Well, because if I've got a long position in my pension, because I own a bunch of American stocks, hey, great. Any profits that I make from that falling today is just going to pay for those longer term investments that I have, or at least hedge them in the short term. So I trade partly to hedge, partly psychological. I just, if I think the market's going to fall for a few months, and my investments are going to go lower, then I'm glad to have certain positions which are short. Now, something like Alphabet, where I'm long on a long term, what do I do in the short term trade when I think, look, the trend, oh, by the way, the green arrow means we got a buy signal. Notice how we're not good enough to get it at the bottom of the market. Don't worry, because that's fine. We got it there. The red dotted line is not a take profit target. I'll tell you what that is in a second. It's where we actually add to our winning position. And I'll explain all of these things in a second. So how do we get that? How do we know that that's more likely than not? There's an increased probability the price will continue upwards. So I've only got a simple decision to make. Hit the buy button. By the way, this is a retail platform which is freely available. It's independent of any brokers and it's free. All the data prices, they're all free for life. Okay, and I chose that to show you because I don't want you paying for stuff, basically. So it's MT4, you'll have heard of it. It's all the data is live, real time, and free. So I'm going to show you how we decide when to get in, when we think there's a trend, and which instruments. And like I said, I prefer also indices. Okay, I particularly like the DAX, because it's Germany and the trends tend to be simpler. Okay, of course it's correlated to the UK and US markets, but I still like it. Sometimes, now this is a difficult one. People sometimes ask me about, well, what about Bitcoin? It's a tough one with Bitcoin. And I'll tell you why. Sometimes it's a no-brainer. It's easy. Look at that. That was a short, went short, and then this long. You're sort of waiting. Okay, albeit you're only waiting today. And by the way, we didn't get in at 4 a.m. or 2 a.m. Nobody was around at their desk to look at that. Given that the market was still several hours later, when everybody got out of bed, was still near the entry, well, you can still get in because it's still near the entry. It's not far away from it. Look, it's still near the entry, so you can get in, goes up, go up. So sometimes cryptos are so much easier to trade. Sometimes they're not. Okay, and it's a tough one, and I wish I could tell you always do it. It's not. I'll show you how we decide trade selection. You can have an instrument which just does great for you for months. Most of the time, Australian dollar is a favorite, Canadian dollar is a favorite against for any major currency. But take the Australian dollar, the New Zealand dollar against sterling. For months, you'll go, wow, this is just too easy. And then nothing works. It's just going sideways. Just, you just got nothing coming out of it. It's just not making you anything. That's life. Okay, that's why we look at more than one instrument. Right, and I'll give you the breakdown of the numbers in the flowchart of exactly how many you should look at. Like I said, watch to the end. I'm going to give you a free gift to all of you. Actually, not one free gift. I've really upped the number of free gifts that you're going to get from books, videos, articles. There's a whole bunch of extra stuff you're going to get as well. So let's break this down now into a proper, feasible working strategy. Or in the words of George Soros, it's not whether you're right or wrong. It's how much money you make when you're right. So what we're going to do is when we're right, we want to ride that. Okay, how do we do that? Because we can't ride it all the time. Sometimes it turns around, it becomes a small loss or just a small win. So how do we increase the odds of getting those 20% of trades which just keep going up and up? Well, let me tell you the difference between a gambler and a trader. And you can take a picture of this. I'm not going to read through all of this, okay? But essentially, we're going to trade small. By the way, this stuff you're going to say, oh, God, you're so cautious, Alpesh. Yeah, it's how I'm still in the industry after 25 years, okay? Caution, 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 caution is, all right, it's the key. Trade small relative to your capital. We're going to do small trades. I'm sorry, but we are. If you're here to sort of, let's do leverage, Alpesh, you're a cowboy, all right? And I'm an Indian, and I don't suggest you do it. Follow the trends established in the market. We don't add to losing positions. Write this down. Losers add to losers, right? We're going to start small, and if the profits are made in the position, we'll reinvest those profits to make more by opening another position. We won't go in big to start off with. Look at the caution. Every single way I could be cautious, I'm cautious. I didn't come up with those rules. The world's leading traders did. When I asked them, every single one, the reason I interviewed 10 of them, and then I published it in my Financial Times columns. You know what? I can tell you everything in this webinar. I can publish it in the Financial Times columns, and then they published it in a book. You're not going to follow me. 10% of you on this webinar will follow what I'm saying. 90% will listen to it and still do the wrong things. That's just life. I mean, my dietitian and my personal trainer tell me what the right things are to do. They write it down. They WhatsApp me. They message me. Do I follow it? No. My double chins prove I don't. It's human nature. We always go down the easy route. And 90% of you will go down the easy route and you won't follow what I'm telling you. That's fine. I'm really speaking in these webinars to the 10% where it's going to be life-changing. Okay? That's it. It's just human nature. Losers add to losers, so we're not going to do that. I'm going to break this down for you. I'm going to show you when we're constructing. It's like I'm showing you what a perfect car looks like, and then I'm going to construct it. And they told me this. I didn't know. They could have said, oh, no, when we get a losing position, we just keep adding to it until it comes around and we bet big. They didn't say those things. Okay? So take a picture of that. This one's the critical one. All right? This is the one. What we do is when we know that there's a high probability of a trend, that green arrow means our system has told us there's a likely trend. And I'll tell you how you can follow those rules of where there's a high probability of a trend is starting. So I'll give you those rules in a second. We have 10 strategies in the hedge fund. The oldest one is the trend following one, and I'll share those rules with you. And for those of you who think, oh my God, you're showing the recipe to Coca-Cola and KFC. We're going to create Coca-Cola and KFC. No, you're not. Okay, me telling you how we look for momentum does not put me out of business. Well, it hasn't yet, and I've been telling people for 25 bloody years. So we'll see. Okay, now, A, that's where it is. All right, that's where it is. So we'll come to that in a second. Now, that's the entry point. That's point A. If you're a beginner, you'd put a fixed stop loss at the point B. What's point B? And you never move that lower and you never add to a losing position. Please write those two rules down, because that has just saved you a bloody fortune. That alone has just saved you a fortune. That's been the price of admission for this webinar already. Don't add to losers. Don't move your stop loss lower. You won't do it. 90% of you won't do it. You won't listen to me. You won't listen to me. You won't listen to John Najarian. You won't listen to the leading hedge fund managers. You won't do any of that. You'll just keep doing the stupid things, and you'll call me back. Alpesh, I made a mistake. I'm down 700 grand because I didn't listen to what you said, and I wish I had. I'm really sorry. I'm really embarrassed. Please don't judge me. I've had those calls. All right? So, A, B is the stop loss. Now, if you're a beginner, fix that. Because you're a beginner, you're just learning. Preferably only trade with risk. Well, always only trade with risk capital, but preferably with a demo account. Don't mess up with real money. Real money is too bloody precious. It's too hard earned, right? When you're learning, you start with a demo account. Brokers won't ever tell you that because they want you to, they're going to take the other side of your losses. Your losses are their profits, so they don't want you doing bloody demo accounts, okay? Point C is just a mirror reflection from the distance from A to B, is A to C, and that's where you would take profit or limit order. Simple. So how do you get B? Okay, how do we set up B? What's that distance? I'll come to that in a second. How do we work that out? Some of you will do it by eye and experience. Most people will say, you know what? I don't want to be stopped out by noise, so I'll put that at a sufficient distance that it's not too far, it's not too close. Now, if you're into technicals, you might say 2.75 times average true range. Entirely up to you. Don't do 2.5, don't do 3. But it's somewhere between those two. There is no magic number. All right. Why? Because the more volatile the market, further away the stop loss. Less volatile the market, closer the stop loss. Obviously. Right? And that, C, is just a mirror reflection. Now, we get our algorithms to do all this for us, obviously, because why would we do it manually? We used to do it all manually. But you can do it manually. If you're intermediate, you wouldn't have a take profit. What you do is just have a trailing stepped, not dynamic, stepped. What does stepped mean? That means when the price goes from A to C, the stop loss goes from B to A. It's stepped. It moves in steps, and the steps are the distance from A to B. That's better. It's marginally better than dynamic, which is every point the price goes up, the stop loss goes up. Your broker will do all this for you. It's simple. Just ask them, I want to set a stop loss. I do it. They'll tell you. And if you're advanced, then you'd have a trailing stop loss, and you'd add to your winners a new position here and have a trailing stop loss there. Why? Because winners add to winners. Write that down. Winners add to winners. Don't worry about that. That's more advanced. Don't start with that. It all comes down to these. We're going to go through all of this. Don't worry. We're going to go through all of this again. Edward said, how exactly do I not cap profits? By not having a take profit order is how you do not cap profits. That's how you let the trend run. You just have a trailing stop loss. So if the price keeps going up, you're not capping the profit by saying, oh, at point C, I'm just going to get out. Because look, after point C, it kept going up. You cap profits by taking profits at point C. Don't do that unless you're just a beginner, in which case it's fine to take profits at point C because you're a beginner and you don't want to sort of overcomplicate things. Okay? Straightforward, simple. Anything you didn't understand, let me know. SELMMA, this is what it comes down to. Stop loss, entry, limit order, mind, money, additional positions. Stop loss, I've explained. It's a volatility-based stop loss. The more volatile the markets, in other words, the more it moves, the more noisy it is. Put the stop loss further away. We use a precise measure. It's roughly about 2.75 average true range. Okay, you can Google average true range if you wish, or your broker will tell you how to find it. But that means it's a volatility-based stop loss. Why? Well, because the leading hedge funds in the world do that. And if they do it, I'm not going to argue with them. I'm going to look at it and I'm going to say, of independent thought, I'm going to think, oh yeah, that makes sense actually. Volatility based, because then it's not fixed for every instrument. What if the market gets more volatile all of a sudden? Well, the stop loss was further away for those markets. Okay, entry, we're going to come to that. It's momentum. Limit order or take profit order is only if you're a beginner. Mind, trading psychology. If you follow a process, your mind cannot sabotage you. That's why I'm going to show you a flow chart. I want you to follow, it's in the next slide. Follow the process. Money, how much money do we put in? So the amount of money we put in and additional positions, let me answer those. Additional positions was at point C. If you're advanced, you do that. Why? Because 20% of your trades will be big winners and they'll produce 80% of your profits because you're adding to your winners. That's the key. That's how you make lots of money. But don't do that unless you're advanced, all right? You do not cap profits in either intermediate or advanced. You are in beginner. Because you're taking profits or limit order at point C. There's a shed load of stuff I've just told you. That's probably about 100 years worth of experience of all the people I interviewed in there. Okay, so don't worry if you're thinking, oh my God, take a picture of this if you wish. Now, we just get our computer systems to do this for us. Initially, it was all manual. What it's doing is giving us all of those. Look at point D. What's point D, Alpesh? Point D is a reminder that not every trade's profitable. There were two trades here, 50% lost money, 50% made money. That 50% that made money, the green arrow to go long, made lots of money, especially because we added to the winner. Why did we add to the winner? Because we could then start small at point A in case it became a losing trade. We wouldn't lose much. But if it became a winning trade, then we could risk the profits to make more. But Alpesh, what if you opened a position at C and then it fell back? Well, I would have risked some of my profits to try and make more, but given them up if it went back compared to if I just took profits. So it's always tempting to take profits because everybody wants a bird in the hand compared to two in the bush. The richest traders, the best traders, the hedge fund managers always prefer two in the bush, i.e. two getting twice as much, but without certainty, over getting one with certainty. Now, I didn't make the rule. That's how they did it. I could argue with them all I want and say, I've got a better way. I know I'm just 27. I was at university. Actually, I wasn't 27. That was 1997. I was 24. I could just say to them, I know better than all of you. I know better than all of you. But I didn't, okay? I didn't know better than all of them. So I started with just copying what they knew. Right? So those SELMMA parts we've done. Let's put it in a flow chart. Take a picture of this. Actually, even better than that. By the way, this is interesting. Will GBP be higher by the end of the year? We're split almost in equal measure between everybody. I'm going to give you this file. Hopefully it'll come through. Share. I'm hoping this file comes through. If you can't get it, just take a picture. It might not come through. It's the first time I'm doing it in a webinar, but something might pop up on your screen where I'm sharing this file for you. So let me just explain this. You want 20 to 24 instruments. You want a mixture of indices, stocks, and currencies. And currencies should be major versus minor, minor versus minor. Why? Because you want as much uncorrelated things to pick from. There's no point saying, oh, I've got 3 positions open. What are they? Oh, sterling dollar long, sterling Australian dollar long, sterling US dollar long, and sterling New Zealand dollar long. Well, no, you've got 1 position in sterling. There's no point. Okay. And stocks are not correlated to currency so much, so you want to mix those things up. 20 to 24 instruments we're going to pick, and I'm going to show you what the figures are in a second. 1 quality trade a day. You'll have about 3 to 4 open at any one time, because by the time the next one comes up, one of your earlier ones will have exited, right? If you want to see what I'm looking at, my Telegram channel, if you don't know where it is, I'll give you the links at the end. It's free to monitor what we're looking at specifically. You're asking yourself, in those, is there a signal? Is there momentum? Which I'll explain to you what the rules are for finding momentum in a second. Is the trend relatively smooth? Okay. Now, no amount of AI can replace the human brain, I don't think, for most things in life. It can for very few things, but most things, I don't think so. And the human brain will pretty much give you a pretty good idea of whether the trend's smooth or not. And I'll show you some in a second. Has it got a good hit rate historically? And by historically, I mean just over, look, let's look at this. This is euro dollar. Short, yep, short, sort of flat, but not too bad. And then long, and it's just carried away. Now, why did I love this? Why are we loving euro dollar? You must say, Alpesh, that's major versus major currency. Yeah, I'm a bit older than you. I'm a bit more experienced. I can do what I want. I'm saying I don't recommend you necessarily do major versus major if you're just starting out. So what did we have there? I'll tell you what we had there. That was the 1st of June. Short. Well, we didn't do it at 3 in the morning. Nobody in my team's awake. We're not big enough to have people in New York and Australia. We're just not that big, okay, as a fund. So when they get to the office, the price was still pretty much at the same entry level. So they thought, oh, okay, we can still take the short, okay? And initially it went against them for a bit, and then boom, collapsed. They didn't know it was going to collapse. I mean, probabilities were there, but nobody knows for certain. If I said to my team, are you willing to bet your wife on it? Sorry, your life on it? And the answer to both would be, well, for wife they might, but for their lives, no, they wouldn't ever bet their lives on any of these trades because there's no 100% guarantee. This one, for ages, just stayed flat. By the time we got to the office, okay, it's still flat, but we get in because it's still near the entry, and then boom, suddenly explodes. Okay, did we know it was going to do that? No. Was there a piece of news? No. Maybe other people got in the office. I don't know. I don't know what moved it. What we know is there was well, wait a minute, Alpesh, how did you know there was going to be a higher probability move? Well, I'll come to that on the momentum and entry in a second. That's all we're trying to do. We buy at 65 and we sell at 75. Let's say we got out now. It's just shy of 75. So we bought at 65, sold at 75. If it was £100 a point, it's £1,000. All right, in whatever, 10 hours. Okay, to give you an example. And you wouldn't do £100 a point at all. Actually, it would be far more than that. Sorry, I'm doing the maths wrong because it was 100 pips. It was 650 pips to 750 pips with the last 3 digits. So it was 100 pips. So if you did £10 a point, it'd be £1,000 in a day on that one. Okay, so all right, get it. Some of them just the trade selection, the trends look smoother. They're not sort of like riding a rodeo horse is going to throw you off. Is the price within the entry still by the time you look at it? Because I don't want you staring in front of the screen all day. I want you to scan 24 instruments, 15 minutes a day. I'm going to recap all these numbers. For 15 minutes a day, you scan these and you pick one quality trade. Why not more, Alpesh? Because the more you do, the lower quality trades you'll end up picking. If I restrict you to one, you'll focus on making sure it's the best bloody thing you can do. Okay, we're short the Dow. I don't know what's happening with the Dow at the moment. I told you we're short FTSE as well. You might say, well, they're highly correlated. They are. That's the Dow, and we're still short it. But notice how the Dow short came a lot earlier than the FTSE. The Dow short came early in the morning. I think the FTSE one was later, if I remember rightly from here, didn't I? Yeah, the FTSE one has come in just now, oddly enough. So the FTSE didn't follow the Dow for most of today. Okay, now, you set the step trailing or fixed. Stop loss, I've already explained. If you're a beginner, I've already told you what you do. And trade size is such that if the stop got hit, you wouldn't lose more than 1% of your capital, preferably 0.5% of your capital if the stop loss got hit immediately. Not if it trailed up a bit, okay, but if it got hit immediately. That's a simplified version. Okay, so I've done the sharing. hopefully you can do that. I know, Vladisław. Right, now imagine this. So let's get to the business plan, then the entry, and then sum it all up into a perfect process for you again, so you've got everything. I know it's a bit sort of, oh, there's a bit of this, there's a bit of that, because it is a bit of that. It's a mechanical approach. There's 6 different parts to SELMMA, so you've got to put it into little bits, and I probably could have organized it in a more coherent way, but let's look at the business plan and then the momentum part and then put it all together. Let's say you did 25 trades per month, which is about 1 every day. Okay, losing at most 1% on any one trade. Let's say 15 of those made 2%. That's over optimistic, but we're adding to winners. So we'll drill this down a bit. So just take these numbers as read for now. So on the losing ones, you lost 1%, and you only had 15 out of 25 wins. So slightly more than 50-50, because we're going to look at momentum, which we'll come to in a second, and trends, and we'll come to that in a second. Okay, and so therefore 10 lost 1%. We'll dial these numbers down. Don't worry, it's a simple plan. Then you would have made 20%, 30, which is 15 times 2 minus 10 times 1. All right. If you've got £2,000, then you would have made £400. Now, let's get conservative and pessimistic. I love being conservative and pessimistic. And if you're conservative at the moment, you're very pessimistic. Let's say you only made half of that, £200 in a month. Well, that's 100% per annum. Institutions can't do 100% per annum, usually. Private investors can. I didn't say that. Do you know who said that? Bill Lipshutz. When I met him, I said to him, how much should I be looking to make as a private trader? That's his number. It's in the book. He said institutions can't because they've got to take far less risk because they're handling pension fund money. Private investors can take a bit more risk because it's just their capital, no regulator saying, you can't do this. What are you doing with this? No boss telling them, whoa, steady your horses there. Okay, that's what they're looking at. That's not bad. Of course it's not bad. Let's halve that again, and let's assume we only make £100 in a month. By the way, the difference between rich and poor is about £500 a month. It's the difference between paying down your rent or your mortgage or your pension, topping up your pension rather, or paying for your kids' education. It's £500 a month for most people. It's the difference between rich and poor, an extra 500 quid. Now, I know what you're thinking. No. The difference between rich and poor is a private jet, Alpesh. No, that's the difference between luxury and rich and poor. Okay, so we're going to look at that. We're going to look at that. Michael said, what is Queen Jubilee? I didn't mention it. Okay. Now, one of the things I want to do, one of the other things I want to do is this. One of the things I want to do is give you a more detailed business plan and also now give you the strategy for entry. Because the one thing that we've left out now, we've covered all the other bits, and I want to go through all of the other bits again as a recap. But I also, let's take Google. Okay, well, why there? Why there? What makes me think that the trend was going to start at that green arrow point? Why not there? How come I didn't get the magical, because I don't have a time machine or a crystal ball to get it there? Why there? What was it about this? Was there anything about that? Okay, and don't forget, I'm very precious with my time, so I'm not going to be looking at news, and I'm certainly not going to be ex post facto hypothesizing that, oh, well, yeah, London market's closed because of the Queen's Jubilee, and therefore it's got to do with the American market, blah, 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 blah. Ex post facto, I can give you any bullshit excuse as to why something's moved. In my experience, when I was doing Bloomberg TV and we were making the financial news, because we were literally making the financial news, I can tell you it's just made up. Okay, we haven't got a clue why things are moving. Neither does the market. Just somebody sees somebody else across the street at Morgan Stanley, sees somebody at Goldman Sachs buying the hell out of something. It beeps up on his screen. He says, let's get on the back of that. Those boys are pushing it up. Why? Because they had a client who had a big cargo order and needed all of a sudden to buy a load of dollars to pay for it. Okay, whatever. Who knows? And so the other guy goes, I'm getting on the back of that. How do I know this? Well, because they told me that's what the floor traders do. It's what David Kite does. He goes, we'd be sitting on the floor and we'd look at the Goldman's guy saying to the guys on the floor, buy a shed load of, buy 1,000 lots of whatever. And we'd say, hey, Goldman's a bank, let's do that. That's all it was. For all the intellectual crap and I've got a master's degree in economics from the world's #1 university. And I can tell you, I never need to use it in trading, ever. I do need to use it when I'm on the BBC because they'll want some kind of intelligent commentary about the markets. I never need to use it in trading, and I've never met a bloody trader who does. I've met analysts who use it, not traders. Okay, if you met traders, you'd know why. IQ of about 5. I'm going to give you the business plan and the strategy again, and then the wrap up. Before I do that, can I tell you something that my hedge fund, right at the end, I'll do it at the end. You don't have to stay for this. But right at the end, something that my hedge fund has launched, some technology that we've launched. We want to float eventually on the stock market like many fintech companies. We want to create a unicorn, $1 billion business. Can I tell you a bit about that right at the end? Okay, it's been my life's journey and work, and hopefully you'll all agree. Okay. This stuff works and you can be doing this, so let's pay attention, right? We're going to focus on entries now, and then we're going to focus on the business plan, and then we're going to focus finally on wrapping everything up. So what's the entry? The one bit, why Google at that point? I think I mentioned Apple earlier, didn't I? So I've shown some of the popular stuff. Where are we on that? That's Apple, which have been short, but that short didn't work. That short worked, but that one didn't. And this one, it's short again. We'll see if it works or not. Apple's not turning out to be good for us. I mean, I want you to think, oh, wow. Hey, Alpesh, everything you touch turns to gold. No, it doesn't. Some of them are good, like this, which is sterling US dollar or cable. Short worked great. That long worked great. But the Apple trade probably won't want to do another one after that for a while because it's just looking messy. Citigroup, which Warren Buffett just bought, I think it was Buffett who bought a load of. Somebody can correct me on that. Well, the short's been going opposite to Buffett on that's been quite profitable over the last couple of days. So it's only the last couple of days. He's not a trader. He's a long-term investor. So what I want to get through to you is we're going to use the same strategy as some of the biggest hedge funds. And the strategies that the big hedge funds use, we have to disclose as well to our investors. Our investors in our fund are Aegon, the pension fund, and AXA. We have to disclose what we're doing. And, family offices, sovereign wealth funds, we have to disclose to them what we're doing for a very simple reason. Nobody's going to give you money if you say, I've got a black box and it's really secret and I can't tell you what we do. It's like a plumber might tell me what he's going to do. It doesn't mean I'm going to be the plumber. So these guys, the sovereign wealth funds, I'm a glorified plumber to them. Okay, they've just hired, I'm a hired gun. My fund's a hired gun in order to do something they don't want to do themselves. And obviously there's a bit of skill, just because a plumber tells me what he's going to do doesn't mean I can just take his tools and do it myself. Okay, so I'm a glorified plumber. Think of it like that. My job is to plumb to make rich people richer. All right. And trend following is used by all of these people. John W. Henry owns Liverpool Football Club. David Hardin is British. He's based out of West London in Hammersmith. He runs Winton Capital. He was one of the founders of AHL, which is run by Man Group, which also is British. Okay, so you've got a big number. All of these people do trend following. Why do I do trend following? Well, I just like it psychologically. You'd say, why don't you do merger arbitrage, Alpesh? Huh? Options trading. I did used to do options trading. Trend following is a lot simpler. I like to keep my life simple. Okay. And also because there's a lot of research behind it. This is from Citigroup, which shows that it actually works. Okay. So I like it. This is from Winton Capital. I stole it from them. 350 billion is wrong. That's not the right number. I think it's closer to 35 billion. And I've got to remove that zero. I don't know why I got carried away with fat fingers. Dangerous, isn't it? That's one of their slides. And that's all we're trying to do. We buy after a bit of a lag from when the trend starts. Why a lag? Well, because we don't have a crystal ball and we don't know the trend started. We certainly don't know. This is important. We're not trying to get in early and we're not bottom fishing. Okay. So that's important for you to know because guess what most private investors do? They try and get in here or they try get in here and they mess it up and they lose a lot of money. The higher probability trade is here. So how do you know that that's happened? Similarly on the soft side, you must, lagging. I don't want to be lagging, Alpesh. Well, that's why you're never going to make money because you think you can find the crystal ball and see into the future, which is what you'd need in order to get down there. That's not my slide. It's Winton Capital. Okay. And we just do that. Increasingly, there's algorithms, computer systems, which find these things. Because why should humans do it? It's too boring. We don't fight against computer algorithms. Trend following is working with them because what we're doing is we're riding their coattails. We're not trying to, and now this is really important. The reason private investors lose so often is they're trying to outsmart the market. They're trying to get ahead of news. They're trying to stand where they think the market's going to go before it's even started moving. We're riding the coattails. We're following the market once it started going in a direction. That's a big difference. And private investors lose money because they're trying to guess where it's going to go and go there first. That's low probability of profits and a high probability of getting run over. Okay, so we try and if a computer has decided or whoever, humans decided this is going to be the trend, this is the direction we're going in, we're trying to ride that coattail. How do we know computers decided that? Well, we don't know whether it's a computer or human, but we can certainly see the prices moving. Okay, and we'll just assume it's a computer most of the time. Okay, so what is it? What does it look like? Well, somebody asked me that, and I put this together. This was at the start of this year. No, sorry, it was the start of this year. It was January. Well, Christmas to the end of January. Christmas to the end of January. Okay, and I picked the FTSE. Christmas to the end of January, that was the FTSE. That's what happened in the FTSE for us. Okay, we had some profitable trades. We had some losing trades, which are marked in red. We had some small wins, which you might say, well, that's a waste of time. You wasted so much time, Alpesh. We had consecutive trades which didn't make money, for instance, which is like that one. Red arrows means loss. Okay, we had, and you can call this one a loss as well from there, which is not marked. So you can say 3 consecutive losing trades. Then you notice how the blues are bigger, even though that one is smaller. That was, would I say this is a typical month? No, I'd say there are no typical months. You know, there's people who, when they go for jobs, they say, oh, you know what I like about my job? There's no typical month. Well, there is no such thing as a typical month in trading. Because I don't want to say to you this is a typical month. How can I say statistically, yeah, 1, 2, 3, 4, 5, 6 winning trades, and 1, 2, 3, call that a losing, 4 losing, 60% winning, 40% losing. No, because I could have a month where it's a bit like tossing a coin. I get 6 consecutive losing trades. Is that typical? I don't know. Okay, so yeah, you can call this typical if you wish. 6 wins, 4 losses, typical, if you wish. I think that it doesn't matter what label we give it. Bill Lipshutz, one of my mentors, I say, he was in the book Mind of a Trader. Going to give you the links to download in a second. Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders. One of my mentors, there he is. He's that guy. His boss, the reason Warren Buffett's on there is Warren Buffett was his chairman, was Bill's chairman at the time at Salomons. People don't know that Warren Buffett was chairman of Salomon Smith Barney, or president, I think they call them. In the case of Bill, if you're waiting to be right 80% of the time, you'll never make it as a trader. I didn't say that. He said it. He was hedge fund manager of the year about 4 or 5 years ago. He became a mentor, a friend, because he was in the book, and I interviewed him. Why did I interview him when I was a student at university? Well, because I wanted to be a trader. So I wanted to interview the world's leading traders, and the FT published the book. And that changed my life, okay, because it gave me insights I couldn't otherwise have had. We're not gambling on news. I've told you that before, and we're not in the forecasting business, just so you know, okay? Forecasters are flummoxed by price drivers for oil. Geez, of course they're flummoxed, okay, because we're not trying to forecast the future. All we're saying is we find a trend, we'll ride behind it, okay? But David asked, what's the time frame? So David, we're trading. Oh, brilliant question, David. Sorry, I think I might have forgotten to mention that. So my favorite time frames for these bars are, you'll see it up here, 30-minute, 15-minute, and 1 hour. They're my 3 favorite time frames. Now you might say, Alpesh, I've got a day job. I can't look at the 1 hour bars. No, because look at this. That's the 1 hour bar. Okay, that's a whole day gone. And it's still, sorry, that's the 30-minute bar. Each one of these is a 30-minute bar. It's still not exited. So you can have a day job. All you've got to do is set a step trailing stop loss and it'll get out. You don't need to be looking at the screen all day. I don't like looking at the screen all day. I don't look at the screen all day. I've got people to do it for me. I didn't used to have, but I've got people to do it for me now. But the whole point is, let's take the Dow. Okay. I don't know when that's going to exit. Do you think I stare at it all day long? Of course not. The stepped trailing stop loss, which is this, which will now be somewhere down here because the price is down here. So it'll be somewhere down here, will get me out. Now, let's say all of a sudden I got a bit worried. I thought, you know what? I want to override my system. Then I will. I'll just say, you know what? Close this position. I'm not happy. It's the Queen's Jubilee, long weekend. You know what? Get out of here. I don't know. I can. That's why I don't like just black boxes. The other reason I don't like black boxes is there's an X factor I cannot program in. For all my wit and cleverness and all the rest of it, I cannot program in one thing, which is when I observe this, that generally, let's say I was looking at this and saying, well, should we pick the next trade in this whenever we get more momentum? I'd say, yeah. We've had some good couple of trades. The bars are fairly smooth. Yeah. Let's wait for the next signal. Right? How do you code that? How do you code human experience? My job with the software is to make sure it removes all the other bits that you can code so I don't have to waste time on it. So let's look at the business plan and wrap that entry level, the entry again. This is why you're all doing it. I don't know SpreadX. It's not an endorsement for them by any means. I don't know them, never met them. Okay, forget about them. The reason I say this, I know why you're here. Profit recorded by top trader, £1 million. Average profit of the top 100, £96,000. Forget all of that. That's there to entice you to open accounts and then mess it up because they know most of you are going to mess it up. Not if you follow the rules I said about how small sizes you trade. Don't add to losers, add to winners only, and entries and trends I'll tell you in a second. We're looking at making 500 extra a month. We're going to do a demo account, so you're not even going to make that until you're consistently profitable on the demo. Only then do you go live. So that's another rule. Please follow that. I'll say it again. Only until you're consistently profitable on the demo account should you go to a live account. That way you risk losing no money. How does that sound? Losing no money. Good, doesn't it? I'm not a broker, so I've got no compunction to make you trade live cash because I don't take the other half of I don't take your losses as my profits. Okay, so I can be on your side. I don't have a conflict of interest with you. My only interest is you're profitable because then you'll say, hey, that Alpesh is really good. You know, books and everything and his webinars. He's really good because I'm making profits. That's what I want. Great. So that's the first thing. 500 a month. Why 500? Well, because if you can have the skills to make 500, which is a number most people can get their head around, most people can't get their head around a bloody million. If you can get your head around 500, then you've got the skills to make 1,000. If you've got the skills to make 1,000, you can make 2. If you can make 2, you can make 3. You can make 3, you can make 6, and so on. So what are the key numbers? Let's put it all together and then look at the entry point and finally the business plan. 15 minutes a day, I want you to scan 12 to 20 instruments on one screen, 1 trade per day, 20 trades per month. Alpesh, is that enough to make you money? Yeah, let's have a look at that. I think it is. I think it is because I'm going to show you the business plan. That's my mum, always makes an honorable visit in all my webinars. Okay, and the next king over there. Now, how much money can you make? Is it worth your effort? Because you know what? By the end of this, you might have a lot of FOMO and you might think, is it worth my effort? And you think, oh God, it's not worth my effort. At least I know. And I'd be far happier if you said, I'm not going to trade because it's not worth my effort, Alpesh. That's brilliant. Okay. Trading is like driving. Initially, look at it, and Alpesh has said to you about stop losses, which is like wing mirrors, said to you entries, which is like the steering wheel. He's told you about brakes, which is like stepped stop losses. He's told you about the accelerator, which is like adding to winners. He's told you about the gear shift, which is about how much money you put into a trade. And it seems too complicated, yet you all learned to drive. And it was a life skill, which was worth having. You first learned to drive in somebody else's car in a car park, not on the motorway in a bloody Ferrari, did you? Because that would be stupid and risky. Okay, and that's what we're going to do trading. With learning any skills, you're going to do it in a sandbox first at low risk. Okay, so the first thing we need, is it worth our while? So we're going to close the webinar with the business plan and then the entry signal. How do we decide when we've got momentum? So we know when to get out. I told you the stop loss rule. Okay, but how about getting in? Well, let's look at the business plan first to see if it's worth our while. So this is what Bill Lipshutz, who was global head of foreign exchange trading at Salomons, put in front of me when I said to him for my book, I want to trade. How much could I make? Which is obviously what you'd ask one of the world's greatest traders if you were sitting in front of him. You'd say, I want to trade. How much can I make? And what's the strategy? So the strategy he gave me, and some of the others just added to it, which I'm going to show you next. And the business plan. He said, well, let's see if it's worth your while first. So he said, imagine your maximum loss is 1% of your total capital. Preferably, I want it to be less. And he said, not today, because you're a student, but in 10 years, or in a year or 2 years, let's say you're good and you're consistently profitable. Let's say you put £20,000 risk capital from friends and family or your savings to it. Not today, because you'd be an idiot to do that on day one as a beginner, or you'd be stupidly rich. Okay, so this is a business plan. Business plan's about where you want to be in life. Okay, it's a side hustle business plan, a side gig business plan. So we didn't call it side gig back then because it didn't exist, or a side hustle. Those words didn't exist. So your maximum loss per trade would be £200 or 1% of 20,000. Let's assume you win 60% of the time, lose 40%. Alpesh, that's pretty rubbish. A coin's 50-50, Alpesh. You're just a bit better than a coin. Yeah, fine. I'll take that all day long. That way I don't have to put pressure on myself to be right all the time, which is impossible anyway. Average loss would be £200. Okay, the average loss would be £200 on that basis, 1% of 20,000. The average win, because we're going to add to our winners, would be £300. If it isn't more than our average loss, we'd pick a better strategy, right? And I'm going to give you the strategy after the plan. So that's another 100 trades we're going to do, because that's a good sample size. So let's say we do 100 trades. Well, 60 of those will be profitable at £300. And I said to Bill, oh my God, that's more money than I've seen. Remember, I was at university at the time. So that's more money than I've ever seen. I want to do this for a living. I want to sit in my underpants. I'm not in my underpants right now. sit in my underpants at a desk and just bang away at the keyboard. Bang the keyboard and make 18,000 pounds every month. This is magical. And as a student, that was appealing. And he said to me, after slapping me, Bill said to me, yeah, what about the 40 which are losing? I said, yeah, but that's just 8,000 pounds lost. That's still 10,000 pounds net profit per trade. That's still 10,000 pounds per 100 trades in this very idealized model. We'll unidealize it in a minute. Don't worry, it's over optimistic. I said, I'm going to be a day trader, Bill. I did the maths there and then, and I was so excited. I still remember it. 100 trades per week. I'll work 50 weeks a year. The other 2, I'll be on my yacht, whatever. I don't have a yacht, by the way. 5,000 trades per annum is what that would mean, because 100 a week, 50, that'll be 500,000 pounds, Bill. I went nuts. And the maths of it would make you go nuts. And I know what you're all thinking, and you should be. Alpesh, don't be stupid. We're not going to do 90% of that. We're not going to do 3/4 of that. We're not even going to do 2/3, a half, or even a third or a quarter of that. We're not going to do a fifth of that, Alpesh. We're not even going to do 15% of that. Let's assume this is so stupidly over optimistic, which it is. We only do 10% of that. That'd be 50,000 pounds. Yeah? No. Still too optimistic. Bill said to me, you're not going to do that, Alpesh. And I went, no, of course I can. Of course I can. He said, no, tone it down. Remember, he's global head of Forex at Salomon, so he knows what he's doing. He said, I want you to keep your job. But why? And I think it's because he didn't want to tell my parents that your son's about to leave Oxford University and drop out, and I'm going to wreck his life. You know, he was a bit worried about that one. So keep your day job, continue training as a barrister, do 100 trades per 6 months. You know what 100 trades per 6 months is? 1 a day. I told you, 1 a day. Scan 12 to 20 instruments for 15 minutes, pick 1 trade a day, 1 quality trade. Okay, just start with that. I know you want to go nuts and do billions. Don't. Okay, other hedge fund managers that I interviewed in the book also said the same. 1 good quality trade a day is how they start their apprentices, how they start their students, rather than going nuts. Okay, 100 trades per 6 months, 200 trades per annum, that's 20,000 pounds a year. So it's not 10%, it's about closer to 4% of our business plan. I went, yeah, okay, that's fine. I'll take that. I don't mind. Well, 4% of your business plan sounds good because it means it's a good business plan. You only need to achieve 4%. You're happy. Still over optimistic. 4% is over optimistic. Remember what I said? Our goal is about 500 a month. Let's say we increase that goal to just 1,000 a month. Well, 1K per month is almost still double 20,000 per annum. So even though our goal is that 4% is still over optimistic, we can afford to do about 1.8% of our business plan and hit our goal of 500 to 1,000 a month. I like those kind of business plans where you only have to do 1.8% of it. Good. Okay. So the next question you should all be asking, because I asked Bill, was, yeah, well, wait a minute, Alpesh, if this is true, why isn't everybody rich? Because that's what I asked him. I said, hang on, if these numbers are good, and this is what he told me, and this will bring us to the most important and last part of the webinar. Well, bad teachers, bad mentors, bad strategies. So let's close off with the entry strategy, because that was the big failing point that he's making. Other than all the bits I told about volatility-based stop loss, volatility-based position size. So, you know, if the stop loss is further away, you basically, whatever the stop loss is, you make sure you don't lose more than 1% of your capital. That's my mum again. 100 trades per 6 months, 200 trades per annum, 20,000 pounds per annum. No, were you paying attention? That's not true. It's 1K per month, or 500 to 1,000 per month. That's our goal, not guaranteed. Right? The whole point of trading is some months you make more, some months you make less, some months you make more, some months you make less. It should average out at about 500 a month. I know, not ambitious, am I? So how are we going to do it? What's the third point Bill was making? The strategies. Okay, well, the strategy is momentum trading. We're going to be that guy. We are riding the coattails of whoever's moving the market. Assume the big guy in the bowler hat is Goldman Sachs or whoever. We're that guy. We are not what most private investors do, is to stand in front of this guy and take the opposing trade and assume the hedge funds are wrong. Or, worse still, stand there and the market never goes there. It just goes somewhere else and you're just stood there looking like a bloody idiot. Okay? This is what I spent my life teaching, that part. Why did I spend my life teaching it? Well, because I was taught it. I wrote it in the books, and it's in my Financial Times column, The Diary of an Internet Trader, which the Financial Times then published as a book. Okay, so I actually diarized it, the weekly diary of an internet trader, every single week, okay, for 5 years. It's over 200 columns. right? So I'm just sharing with you what I've been through. Why? Well, everybody wants to feel relevant, don't they? Don't want to feel a has-been, do I? How do you measure momentum then? What is that strategy? So there's many different strategies of trading. I'm just going to focus on our original hedge fund strategy, the first one out of 10, and the one which is my favorite because of my firstborn. But actually, it was taught to me by David Kite. It was taught to me by Bill Lipshutz. This is all it is. Okay, so I said, well, how do I find if a trend's going to start? How do I find momentum? Okay, this is it. Maz said, I didn't account for compound interest. There's no need to account for niceties like compound interest. You know, if you're making a lot, what the hell do you care if you were undercounting that and you made even more? Do you see what I mean? Compounds are icing on the cake. How to measure strength and momentum, right? So I said to him, how do I know if a trend's starting? He said, look, you're a poor student. You're not going to afford expensive software and tons of analysts. And I said, no, I'm not. He said, so you're going to have to use free things which are already out there, but just change them a bit. And he said, one way you could look at things is the price closing near the high? Because if it's closing near the high, chances are the next period, there's a great probability it'll move up, then it'll move down. It's a bit like those auctions on TV. I've got 80, anybody give me 90, I've got 90, anybody give me 100, I've got 100, anybody give me 110. That's momentum. And I said, well, how the hell do I measure that? And he said, well, there's lots of free tools out there. They're not good because they're not right. And I said, well, why the hell am I using them? He said, you're going to tweak them a bit. And what you're going to do is you're going to take the best bits of all of them and filter. Like the MACD, I know, looks awful. Don't worry about it. All it does is measure three things. Is the price closing near the high? Is it making higher highs? Is it making higher lows? Those are three different ways of measuring momentum. So he says, you're not going to use one way. You're going to use three different ways. What you're going to do is, in effect, do what all hedge funds do, which is have multiple indicators. Okay, is the price making higher lows? That's one indicator. Is it closing near the high? That's another indicator. Is it making higher highs? That's a third indicator. So you can have multiple indicators, two across multiple time frames. Okay, so you're not just going to look at the time frame you're trading, which is a 30-minute. You're going to look at the next time frame along, which is the 1 hour, to see if the same thing is happening in the longer term time frame, because that increases the probability that that will spill over into the time frame you're trading. All right, so multiple time frames. And the third thing you're going to do is, and I'll come to this in a second, is PC and PR, but I'll come to that in a second. Okay, now, what about these indicators? I said, well, wait a minute, just because I'm using lots of indicators doesn't mean I'm more accurate. If each one of them isn't working often enough, and he said, no, you're going to use them the way the textbooks don't. So you can write this bit down. You might want to take a picture of this. Textbooks. We're not going to do it the way the textbooks do. I said, so what are we going to do exactly? Given that these are free, what are we going to do? And he goes, look, for a poor student, this is the best it's going to get for you, son. All right. I said, you're all right. I'm not going to go and hire, billion-dollar analysts and all the rest of it. So the MACD was just telling us if the price is higher highs, closing near the high, higher lows, together with the stochastic. And he said, the way we're going to do it is in a way that the textbooks don't. So you're going to look to see if it's flat to rising, because things like the MACD are lagging and things like the stochastic are too early. So these indicators, which are freely available on software like this, for instance, okay, freely available on software like this, for instance, we're just looking for points where multiple indicators, stochastic, RSI, MACD, stochastic, are flat to rising, okay? Multiple time frames, so not the 30-minute, but also the 1 hour as well, the next time frame along. And then what we're looking to do, is take that and look for one final thing, which I'll tell you in a second. Okay, so that's flat to rising. So I said multiple indicators, multiple time frames, right? Flat to rising, stochastic MAD, flat to rising. Why? Because it allowed for the lag in some and the prematurity of others. The final thing was PC and PR. What's PC? Price confirmation. That's what it is. That's the final third thing. What's price confirmation? It means the price has made a 2-period high. If you're trading 30-minute bars, it's made a 2-period high. And that's when our system tells us green arrow. So what that system, our own programming does, that you can do it manually, is it scans all of those instruments and says which have got flat to rising, MACD and stochastic, okay, flat to rising, and 2-period high, and then it gives us a signal. It can alert us on our cell phones if we wish. I prefer with my staff that they don't have alerts, because otherwise they tend to overtrade, and it's better that they don't, because we're fighting psychology. Remember I said mind earlier? It's better they just scan for 15 minutes, pick one quality trade a day, 15 minutes start, or they can just do it 2 hours on a Friday and pick 5 trades, do 5 trades then. It's up to them which way they do it. So what are these red crosses? Well, there's two ways to exit. One is, as I said, the trailing stop I told you earlier, or secondly, these red crosses our system show when the initial entry conditions no longer apply. In other words, the momentum has fizzled out. It's no longer rising, it's falling, and so on. Okay, that's it. That's it. Multiple indicators, multiple time frames, flat to rising. Right? Why is it effective? Well, it measures momentum for a start, and it looks at multiple time frames. Right? So it confirms it. Right? And it qualifies it with 2-period high. Now, why do we need a 2-period price high? Well, because otherwise we might be looking at something that nobody else has seen. When somebody has pushed the price up as well, we know there's momentum. We've got a higher probability of a good trade. Most of the people I can teach this to, this is a talk I gave at Bloomberg. They can be everything from full-time moms to students to full-time plumbers, business owners, in-between jobbers. My point is, in the words of Einstein, if you can't explain it to a 10-year-old, you don't understand it. We're looking to see high probability trade, multiple time frames, flat to rising indicators, right? Because that gives us increased probability of a price moving higher. That's all it is. That's all it is. Now, there's 9 other strategies we have in the fund, but we have that taken together with trading stop loss, stepped, adding to winners. When you put all that into an explanation to a family office or a sovereign wealth fund, they go, yeah, we can see your risk management. We can see you're starting small. We can see you're adding only to winners. We can see you're looking at momentum and trend following. We can see others do that. Yes. Okay. Now, we might add to that our instrument choice and say to them, look, unlike other funds, we don't just focus on equities or just on Forex. We will look at everything. And guess what? Guess what flavor of the month is? Guess what raises capital the most at the moment? And you can put it into the chat box. Guess what instrument, if you say to a sovereign wealth fund or a family office or a potential investor in a hedge fund, which instruments we're doing, guess what gets them more excited than anything else? Okay, do you think it's saying tech stocks? Do you think it's saying indices? Do you think it's saying Forex? Or do you think the answer is something else? I'll give you a clue. It's something else. Guess what it is? And you can write it in there. Okay, so I started perfecting this when I was at university. That's me at university, Red Carnation, lost exam. That's when I met Bill Lipshutz, when I wrote the book. I won a competition in the FT as a result, and on Channel 4 Show Me the Money, and on Bloomberg, on various things. And the FT therefore said, your name's coming up a lot. Would you like to write a book on this? And I said, yeah, I would. First of all, it'll give me profile that I want and get my name out there. And it'd be great for credibility when you're raising capital. So as soon as I won the competition in the FT, I thought, I've got to set up a hedge fund. I mean, obviously you would, wouldn't you? You think the next step up. You don't think the next step down, especially not given the university I'd been to. And as I said, won the competition, set up the fund. That's me at the fund's first set of offices, partly paid for by the likes of people like this who licensed my research and software, and Merrill Lynch, HSBC, and they put me on the front cover and all the rest of it. Them, together with people like American Express, they all in total paid about $1 million. I used all those fees to set up the fund because you reinvest, don't you? And Barclays then approached me and said, look, you've got some technology here. Would you like to float this company? It was a specific chap there, Biku Alawalia. He introduced me to Ashok Vaswani, who's just left Barclays now, and he was number 4 at Barclays. But Biku said, why don't you float the technology? And I said, no, I'm not interested. He actually wanted me to mentor him. I said, I don't have time to do that. I've got a fund to run. He said, yeah, but what if you had a fund to run and a fintech technology, which could be $1 billion technology? I said, how would I do that? So he came up with the idea for this. Okay, this is his idea. And he said, well, look, people want to learn this at their own pace, but they don't want to pay subscriptions every day, every week, every month, because that's taking money out of their pocket and they don't have a lot of it. They want the convenience of being able to do it from wherever they are without having to travel to hotels and all the rest of it. They want to be able to have remote access and look over your shoulder to see what you're looking at. But at the same time, you look at what they're doing, thanks to modern technology like Zoom, or, they can WhatsApp you or whatever. And I said, yeah, I like the sound of all of that. We'd be solving a big problem here, and we'd be broker independent, which is great. We'd give them lifetime updates, no ongoing charges. And I said, well, how does this make us enough money? Why would we do this if we're not going to charge subscriptions? He said, no, you'd get enough people, then you'd get venture capital investment showing that it works, and then you'd IPO it. And I said, okay, that looks interesting. And then from the public markets, you'd make the money. And we came up with a whole idea, and we said, well, okay, look, any system, any approach, where if we're doing the hard work for them, so instead of just saying to them multiple indicators, flat to rising, multiple time frames, price confirmation, add to your winners, step trading stop losses, volatility-based stop loss, volatility-based position sizing. If we're going to do that, we'd want to teach them more about it. So we'd want to give some kind of course that they can look at, which is updated. We want them to look at what we're doing every single day as well. We want to be broker independent and not charge them for the data. Make sure all the data is live, real time, and free for the rest of their lives. And all the upgrades are free, and they've got access to me, presumably. We really want to, you know, if you want to be amazing, you got to be amazing, right? And of course we know. So that's what we did. We took all of that, what I've just said to you in this, and we put it into all of this, this is all free, all of these instruments. We put it into our indicator, which then tells us and does the hard work for us. Multiple indicators at that point were flat to rising, multiple time frames, price confirmation, 2-period high, and then we added all of this in for private investors. So it actually went further and said, look, if you want a maximum loss of £100 to that stop loss down there, then do 0.01 stop lot. And the pip is this much, and you know, and so on. So it did all the maths for them, and actually gave them access to me and no ongoing costs. Without an indicator, we found they were doing this. With an indicator, because they could look at more things and it was scanning the markets for them constantly, or they could pick their own markets, entirely up to them. They were doing this. So they got more time efficient. They had confidence. You can see orange after because we tested all of this before launching it. I wasn't going to waste my time, you know, sort of taking a guess that something would work. So we tried a whole load of people with before the indicator, after the indicator, and then polled them, measured them, and this is what we found. They basically got of exits, entry, stop losses. Biku from Barclays decided to call it pipspredator. Buy when the price goes above the horizontal line, because that confirms this price momentum. The odds of a move have increased. So it took the best parts of what the best hedge fund managers had told me, which I'd published in the FT books, put it all into a piece of software to solve a major multi-trillion-dollar market problem, which is private investors, 40% of them lose money. So that's trillions between, you know, those losing money on Saxo, CMC, ETX, IG, and all the rest of it, all right? What we found, the best time frame we found was this one. Doesn't mean it's the only one we do, but I want you to look at this. The best time frame we found, he says, if you can find his mouse, the best time frame we found was this, the 1 hour time frame. Why? Because the number of trades in a month, where we got signals, 1 a day roughly, remember I told you, net pips captured, winning minus losing. Remember, some months you get more, some months you get less. You average that out, and that's where you're left at. Okay, it's where you're left at. That's your average, and we want to try and do 500 a month for private investors, because that's manageable psychologically for them, right? 2,250 points. Best win-loss streak, 70 wins out of 100. Worst, 30 wins out of 100. That's not what matters, as you saw earlier from the quotes from George Soros and Bill Lipshutz. It's that net pips captured. Now, some months there were more. It might be as high as 4,000. Other months, they've been low as 0 or negative. Okay, it's what on average it becomes. That matters. Let's say you did $2 a point. Don't do that. There's brokers out there, there's software vendors will tell you, oh, do £3 a point. Then they realized I was calling them out and they said, oh, do £1 a point. No, they want you to use their brokers because they get the profits. They purposely make software which is going to lose money because they make more money out of the broker you're tied to taking the kickbacks of the losses. The brokers are like the casino. They make the profits from the losses you make. They're not like estate agents matching buyers and sellers. That market's long gone. Okay, they're like casinos. They get the other end of the trade. So they want you to do £1 a point or £2 or 3. I say do a demo account because I'm broker independent. I don't have a conflict of interest with you, unlike the software vendors who want you to lose money as quickly as possible and then they move on to the next guy, right? I need you to make money because we need, as you'll see in a second, 1,000 testimonials, because that puts up the valuation to the venture capitalists and eventually for the market. Okay, that boosts the valuation of my company. So let's say you did do 2 for a second. Well, that'd be 2 times 2,250. That'd be 4,500. That'd be your potential profit. No, hang on. I said 500 a month is what we're looking for. 10% of that roughly. So it's not $2. It's 20 cents a point you can do, or a pip in the language of trading. 20 cents. 20 cents, good. That's for the mass retail market. That means that in a losing trade, 20 times 50 pips or points, you'd lose, guess what? $10 or £10. That's not bad. Okay? We want you to do 20 cents. There's some brokers which allow you to do that. I don't like doing £1 a point because you can lose a lot of money too quickly. And that still keeps us in check for our, or on target for our 15 100. That's what we did. We then put it together and said, well, let's give people a business plan. Let's give them practices, tests, let's give them an exam if they want to do an exam, because 8% want to be hedge fund managers. The rest don't want to do an exam, and that's fine. Let's track them. Let's give them a 12-week course and a 30-day course, which is theirs for life, and it's updated all the time. But I say 12 weeks because 12 weeks is a good time frame over which to learn. Some will do it in a week. Others will take a year just because they're busy with other things. Let's benchmark them. Let's give them access for life. Let's do more than that. Let's give them a 30-day money-back guarantee. No quibble. Okay, that's for life. All upgrades for life. No subscription. No subscriptions. No other costs. Let's give them the weekly updates, daily actually updates on their inboxes. Let's Zoom call them, right? Let them look over my shoulder to see what trades we're examining each morning. Because like I said, there's so many instruments. And let me look over theirs because they're going to send me theirs. And then we found, well, wait a minute. Why would venture capitalists do this? This is why. And if you want to download this, I'll give you the link in a second. This is why. We don't have any competitors. There's nobody out there who can compete with hedge fund managers using this fintech. There's no professionally trained communicator. I'm a master and trained by Bloomberg. There's nobody who's got those credentials paid by Financial Times and Bloomberg. There's nobody who, as a visiting fellow at Oxford University, continue doing the research out of some of the clever people from there on the algo. So we're always monitoring, and we're on version 4 now, who's won awards in the FT. So we thought, you know what, we should use all of this because we can blow them up. We believe in what Peter Thiel of PayPal said. You're an idiot if you compete with others. We don't compete with anyone. We want to create a market which is unique. So we're not competing with the Muppets. We can blow them out of the water. Okay? Can it make money? Well, I'll show you some of the other trades. Is it easy? Well, you're following signals. Can I do it anytime? We're hand-holding. You can do it anytime with a day job. It's creative for people to do it around a day job because we've got a day job. My day job is raising capital. My day job isn't sitting in front of a computer screen. I've got staff who can do that. I can treat a 16-year-old monkey to do that. Does it make life easier? Yeah, that's the whole point of it. If it doesn't make life easier, don't do anything in life. Simple rules. We'll give you the checklist. We'll give you the course material. We'll give you access to me. Talk to me, my team. We've got a whole team who can install it for you and everything else. This is one of my students. So full disclosure, not one of my trades, one of my students who went against my rules and did 5-minute bars and then showed off and said to me, oh, 5-minute bars. This is an older one from one of my initial students, my very first students. This is when we started getting excited, saying, I think we're onto something here. And they did US dollar, 5-minute bars, 3 hours, 75 pips, 75 times $30 a pip, 2,250. I'm not going to go through all of these. So who endorses this? Well, how about this? Chairman of the Chicago Board of Trade. That's what he said. And it's in print on the cover of my FT book. Gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies. Clearly elucidating the methodologies of successful trading strategies. You can't get more bloody clear than that from the chairman of the world's largest exchange. Okay, it's not Mrs. Smith from Croydon or some actor, Mr. Jones from Manchester. We know we've got no competition in this space because nobody has bothered to create this for the mass market because they've all the hedge funds have thought, oh no, there's no money in doing anything retail. They're right. For them, there isn't, unless the money comes from the IPO. The money comes from the venture capitalist investors. Okay, so that's the route we took. Don't worry about that. That's what I think life's like without an indicator. You're doing it too manually. Now you can do it manually. I've given you all the information to do it manually. Okay. 30-day money back guarantee. What I've done is, I dare say that we're going to take 2,000 people in batches of 25. They're in it for life, but I take them in batches of 25 because I onboard them and mentor them personally. I'm a bit like Steve Jobs when he launched the iPhone. It's my baby. I'm the one in front of the camera. I'm the one on stage.